Welcome everyone to Wellington's first half 2017 conference call. I'm Howard Milliner, Wellington's CFO. You'll all likely have seen Wellington's interim report and stock exchange release. The call will go through the normal format. I'll make some comments on the financial performance for the half, and Greg will then provide an update on the business as we progress into the second half of 2017. Greg will also talk a bit about the exciting opportunities for Wellington in the digital space. I'll start with the usual warning. We'll be making some forward-looking statements on this call today, and as these are predictive in nature, they're subject to a number of risks and uncertainties relating to Wellington, its operations, and the markets in which it competes. Some things are beyond our control, unfortunately, and actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. For the first half, all the financial metrics for the half were positive. Revenue, in New Zealand dollar terms, revenue increased from 18.7 million in the first half 16 to 23.8 million, a 27% increase. In US dollar terms, it was a 34% increase, so the higher New Zealand dollar USD cross rate had an impact on reported revenue. In volume terms, we shipped 36,000 more motors than the comparable period, a 6% increase in volume, and a 9% increase in US dollar revenues. There was a move for some customers away from legacy motors to the new ECR2 motor, which is a positive for us. We supplied twice as many STS controllers as we did in the whole of 2016, so this was the main driver to Wellington's revenue growth. Gross margin improved by 2.5% to 24.9% in the half. 25% has always been stated to be our target, but we expect now to see further increases as STS Connect volumes increase and as we secure more revenue from digital services. The margin on all ECR motors improved slightly despite continued pricing pressure from big volume customers and brands. Profitability, EBITDA improved to 1 million for the half. An EBIT profit of 181,000 was recorded. The loss for the year was 522,000, although this included 519,000 of costs, both interest and exchange rate gains losses, in connection with the mandatory convertible preference shares. So arguably the trading result was a $3,000 loss for the half, a massive improvement. This improvement was driven by increased volumes and increased gross margin dollars on that volume. OPEX costs have increased 0.9 compared to the same period in 16, mainly due to increased sales and technical headcount to support our new products. We continue to invest in customer-facing growth skills and software development skills in New Zealand, which is helping to deliver our growth and profit improvement. Cash and working capital. We closed the first half with 1.2 million of cash, down from the 2.1 we had at the end of 16. Operating cash flows amounted to 0.3, although this excludes capitalised development labour. Trade receivables at 10.5 million represents 80 days sales at 30th of June 17, compared to 71 days sales for the same period last year. This year, our second biggest customer unilaterally changed its payment schedule, moving from weekly payments to twice monthly payments for all its suppliers. It's very difficult to counter this, other than by a refusal to supply, which is not a practical response. This had an impact on our trade receivables. In Mexico generally, customers are regularly asking for longer terms. We've been successful resisting this pressure, but an increasing local manufacturing presence from a motor competitor offering just-in-time lead times versus our supply ex-Vietnam China is a new dynamic that we are countering. Inventory was 4.1 million compared to 3.5 million at the end of 16, with inventory turning 4.7 times in the half compared to 2.8 times for the same period last year. We are seeing some increases in inventory due to customers deferring orders and due to the need to shorten lead times to combat competitive threats. The improvement in turns is pleasing, although we know we can do better. There are inventory initiatives underway to this end. It was pleasing that the company secured an extension to the repayment date for the Smart Shares loan facility through to March 2019, although the interest rate for the extended term was higher than we would have liked. There is little doubt that cash will be under pressure in Q4, and this extended term gives us some headroom. As reported in the interim, the company is looking at various options to provide the capital it needs to grow, and Greg will talk more about this shortly. At this point, I'll hand the call over to Greg.
Thanks, Howard, and hi everyone. We'll be doing a quick Q&A at the end of the comments, so hang in there. Thank you very much. There are certainly some exciting developments in the business, not the least of which, of course, is our continually improving financial performance. But today I'm going to try and focus more on the operational and strategic developments that are behind our 2017 numbers and our longer range outlook for next year. The adoption of our SCS Connect product continues at pace, and as Howard already mentioned, we've already shipped twice as many units as we did for the whole of last year. Part of the reason for this is our developing Internet of Things ecosystem, our expanding range of digital solutions, and in particular, our digital marketing and consumer engagement product range that we've now started to trial with iProximity in the market. Our ECR2 motor volumes also continue to grow with the addition of several new customers for this product. And we're also seeing growth in one of our legacy products, the ECR92 motor, which is our lowest cost product. The main market driving this growth is the Americas, but we are starting to see interest in some Asian markets also for our new motor. We were very pleased with our EBITDA profit for the half, and also our first ever EBIT profit that Howard mentioned. I think our financial performance continues to go in the right direction, and accordingly, we are signalling a target of net profit and cash generation for 2018, for next year. We were super excited to announce an exclusive partnership with iProximity. They're an Australian-based, proximity-based digital marketing company. Their digital marketing tools, when coupled with our SCS Connect data platform, are already delivering consumer engagement experiences for our brand customers and enabling our new Smarter Cooler product for beverage brands in a number of field trials. The vision of Wellington and our new partner iProximity is through our joint Smarter Cooler solution and our growing fleet of SCS Connect devices, which actually provides one of the largest installed bases of beacons in the world. We will take a digital marketing offering to large global food and beverage retailers. So using Wellington's SCS beacon and data platform and iProximity's tools and content management system, we're already demonstrating to customers how connected coolers can communicate directly to the consumer and deliver brand messaging that can improve their product sales. Before I go into a bit more detail on our product and initiatives for the rest of the year and into next year, let me just break down the regional sales performance a bit. Sales performance was strongly positive in 3 of our 4 regions, 35% growth in Latin America, 230% growth in the USA and Canada, and 8% in Asia Pacific. The exception was Europe, where sales were down 22%. The European region remains the company's most competitive and price-sensitive market, and it is a problem for us, but we believe it's a problem that can be solved. We're right in the middle of a strategic review of the EMEA market, both at a product and skill investment level. Early findings are that we will need a different approach to products in that region, where there is a great deal more focus, for example, on cellular connectivity versus the Bluetooth we have in our SCS Connect. We also think increased investment in certain targeted countries, particularly around sales and technical field staff, will be essential. I intend to let you know more about our European recovery plans as we decide on what to do. So now let me dig into some of the product and strategic initiatives we have, particularly around Smarter Cooler and what we're learning from the market that is shaping our offering. Firstly, what is a Smarter Cooler? Commercial refrigeration systems that our customers use fitted with our SCS Connect already lead the way in Smarter Cooler technology with asset tracking and operational performance management. The Smarter Cooler concept combines our platform with the iProximity beacon management platform to provide that digital marketing engagement with our brand's consumers. Some of the things that solution provides, it can wake a consumer's phone with a branded message when they pass by a cooler. It can deliver personalized promotions to the consumer on their device. It can help our customers build real-time data insights on consumer buying behaviors. And it can engage with customers at a very personal level, delivering offers on behalf of the brand and the retailer. We're actually already operating this system under trial in several large supermarkets in Central America, and it's shown the retailers and the brands how product sales can be positively impacted by our solution. So in turn, we're very clear on what will determine where we invest over the coming months. The SCS Connect hardware is now adopted by 2 major global beverage brands. The majority of the SCS revenue so far is driven from Latin America and the EMEA region, but there are very fast developing market opportunities in Asia and the USA, which we think will turn to revenue late this year and early 2018. So with this solution, we're helping solve our customers' business problems, and we're testing the commercial viability of the new digital products we have in the market. So a couple of examples. Customers are integrating our cloud-based business reporting tools into their operating models. This is taking time, and we're also finding that customers are requiring modifications to software, firmware, and digital solutions. So we're developing new software products to support their individual needs. We're continuing to market SCS Connect into new countries and are also exploring new market segments beyond beverage coolers where our SCS and iProximity digital tools could add value. There are certainly attractive markets for our IoT solutions outside of our core beverage market. We know that customers require choices in connectivity. I already mentioned how Europe is more focused around cellular. So we are putting a lot of focus in an area of research around alternate connectivity technologies. Bluetooth is great for mass adoption, but the alternate real-time communication technologies could well be our next step. Our strategic product focus, therefore, has us looking at 3 distinct areas: a broader portfolio of IoT or Internet of Things devices and smarter, cooler digital solutions for beverage and non-beverage markets. The second area is continuing to develop high-performance EC motors like the ECR2, where we can grow our market penetration in the beverage market. And number 3 is joint product development initiatives with our partner network in Australia with iProximity and Vietnam and China with our supplier partners to bring a new range of low-cost motors and IoT products to market. Finally, let me close with a few comments on our outlook for this year and our outlook for next year. We had a strong first half performance, and we're building on the success of our new products. We continue to win new EC motor customers, and we're expanding our SCS customer base, particularly around digital services. We are, however, still seeing demand seasonality in our business, but what is different is the overall demand situation is rising, both due to our new products, but also due to positive customer and market dynamics. Some customers are deferring Q3 demand into Q4 and Q1 2018, so we are expecting an EBITDA loss in Q3, but we will return to profit in Q4. For the full year revenue, we're expected to grow in the 25 to 35% range, and we are expecting EBITDA profit of between 1.5 and 2.1 million for this year. Quickly looking at 2018, we're moving beyond the motor, as we've already talked about over the last few years, to beyond the device. And we are starting to prove we can be a major player in the Internet of Things and digital solutions market for our commercial refrigeration customers. And we're also starting to explore some non-refrigeration markets. We firmly believe connectivity and digital solutions will underpin the mid to long-term future of our business, and accordingly, we will focus our resources and investment next year on this space. Just to be clear, though, we are not a pure software services business. We are a hardware-enabled software and solutions business, and we will continue to develop a range of EC motors, connected IoT hardware, and the supporting suite of digital products that go with our hardware ecosystem. This approach is taking us firmly into the digital economy. So with all this expansion of products and services, we're targeting 20 to 30% growth next year, and we feel the company can generate positive operating cash flow and achieve its first net profit in 2018. Before I finish and go to Q&A, I would like to just head off a question that you may all be ready to ask. Are Wellington going to be raising money to fund all of this growth and innovation? What I will say is we think a fast-growing technology company like us requires flexibility to support a broad range of growth opportunities. We also think we aren't that far away from being able to fund many of these from operations. A really interesting thing about our new IoT data business is we actually get paid for long-term data plans up front. So our new developing business model is quite cash beneficial. And as we grow it, it underpins our cash performance. That said, with continued revenue growth in the 30% range, a number of large customer opportunities in the funnel, new products being researched, particularly in digital, the expected growth in our iProximity digital partnership, and further technology partnerships being contemplated, we just want to ensure we can move fast when we need to and not get left behind. So we're not sure if we need to do anything yet, but the board is always assessing the best options with respect to future growth capital needs so we can take advantage of opportunities before anyone else does. Thanks for listening, everyone, and I'll now go to Q&A.
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question, and we'll pause for just a moment to allow everyone an opportunity to signal. And we'll take our first question from Murray Graham with SNBC.
Hey, Murray. Hey, Murray.
Good morning, Greg and Howard. As you look to broaden the portfolio of your Internet of Things and smarter solutions going forward, and also obviously continue to build on your high-performance ECR motors, what do you think the sales mix between the two is going to look like over the next 2 or 3 years?
Next year is probably a good, Howard, carrying on, maybe next year is a good proxy for that, if you could comment on roughly on the sales mix. I don't want to give too much away out there, Murray, in terms of competitors that may be listening, but can you give some broad numbers,
Sure.
Howard?
I would have thought that next year the SCS Connect would be something like 25-30% of gross revenues.
Yeah.
So that's, it's obviously increasing, year on year. This year we've doubled the number, so 100,000 in the first half. 100,000 in the first half is probably 4 million, 5 million of revenue.
Yeah. Okay, thanks, Howard.
Anything else, Murray?
No, that's okay. I'll just leave it open to anybody else.
And once again, that is star 1 if you'd like to ask a question. It appears there are no further phone questions at this time.
Okay. No one has any other questions? That's good and bad, because we've got 7 more minutes. Not that I want to take it all up. Murray, just one other comment to your question, which I think is worth noting. That 25% to 30% revenue mix, I think Howard was referring to, was hardware and some data, because obviously we map data revenue across the length of the contract, although, as I mentioned, the cash comes in up front. What it doesn't include is our developing kind of digital services and digital solutions on top of the data platform. So that's something that, we've only just started to trial and sell, and, as that grows, I think they'll be adding another layer of the revenue mix to the business starting next year and then growing beyond that. Digital services.
Thanks. In terms of the early adopters of this technology, it would appear to be Central America. They're the ones that are sort of getting involved. Why do you see them as being at the forefront as opposed to perhaps some of the other more developed countries?
Yeah, I think what's happening is that the brands that are trialing this consumer engagement software, they are North American brands. Actually, some of the non-carbonated soft drink brands are based out of Europe, but they're just picking geographies where, for a couple of reasons, there's maybe a more open mind to kind of technology adoption, and certainly we're seeing that in some of the retail networks in Central America. For example, in the US, there is a push to develop this in the US, but it just seems to be a lot slower for the decisions to be made in the retailer companies in the supermarkets and like in the US. So the big brands that are looking to implement this stuff are using Latin America as a test bed, but that's not necessarily the only market that they're going to roll out in once they decide to go.
Right. Okay. And just coming back to your ECR2 growth, or your ECR growth of about 6%. In terms of the adoption of the ECR2, is that cannibalising some of your existing business?
It does cannibalise some ECR1 business. There's three customers for the ECR2. There's existing bottle cooler customers, our large beverage van bottle cooler customers who are moving from ECR1 into ECR2. It's a better motor. Then there's the supermarket display case manufacturers, who we've always said are a higher value-added customer, and that's proven to be the case. And that's mainly in the US that we're seeing adoption of those. And the third customer, which is where our sales partner, East West, who's also our manufacturing partner in the US, has started to get some success, are non-refrigeration customers who need an engine in like a pump or something like that, or another air movement device that's not refrigeration. They are also having some success selling ECR2 into those markets. So with ECR2, we've actually opened up two brand new markets. We were already in beverage coolers. We're still in beverage coolers. Now we're in supermarket display cases and food service. And with East West in the US, we're moving into non-refrigeration air movement applications with ECR2.
Interesting. Thank you for that. Thanks, Greg.
No problem.
It looks like we have another question from Grant Taylor with Forbar.
Hello, Grant. Grant? We've lost Grant.
Unmuted, Grant.
Oh. Hello? I got music there. Grant, are you there? Operator, do we have a problem with Grant?
It looks like he disconnected his line. Or dropped from the queue.
Oh. I'm sure he had a tough question as well.
Once again, please press star one.
Okay, one last chance. One last chance if you had any more questions. Otherwise, I think we'll call it a day. Okay. Look, my cell number is 778-238-6494 if anyone wants to reach out to me directly. And Howard, you're available there in New Zealand as well for any direct calls. Thanks for listening, everyone.